Debt Market Update, November 2020. The yield of 10-year benchmark G-Sec was at 5.91% for the month ended November 2020, up 3 bps over the previous month end. The G-Sec yields traded largely within a narrow range during the month, supported by high liquidity, Operation Twist, etc. 10-year AAA-rated corporate bond spreads over G-Sec moderated and ended down 13 bps compared to the last month. The average net interbank liquidity surplus improved during the month, driven by OMO purchases, foreign exchange purchases by RBI, along with soft credit growth vis-à-vis deposit growth. The FPI flows in the Indian debt markets have been relatively weak in the current financial year. In November 2020, FPI investments in debt were marginally positive at $0.3 billion. Consequently, in 8M FY21, net FPI outflows from debt stood at $3.6 billion compared to net inflows of $4.4 billion during the same period last year. In its meeting concluded on 4th December 2020, MPC unanimously voted in favor of keeping the policy repo rate and reverse repo rate unchanged at 4% and 3.35%. It also voted in favor of maintaining an accommodative stance as long as it is necessary, at least during the current financial year and into the next financial year, to revive growth on a durable basis and mitigate the impact of COVID-19 on the economy, while ensuring that inflation remains within the target going forward. Outlook: RBI's decision of leaving the policy repo rate and accommodative stance unchanged was largely in line with market expectations. While RBI revised up its growth and inflation forecast, no liquidity absorption measures were announced despite high liquidity and easy financial conditions. The RBI governor mentioned in his speech that RBI will maintain ample system liquidity and will continue to use tools like OMO purchases, Operation Twist, reverse repo, etc. at the appropriate time. This was perceived positively by the market, and G-Sec yields rallied to some extent. Since the outbreak of COVID-19, RBI has been proactively taking steps to cushion the impact of the pandemic on growth. In addition to a sharp reduction in policy rates, RBI has undertaken multiple conventional and unconventional measures to improve liquidity and maintain easy financing conditions. It has conducted OMO purchases, Operation Twist, LTROs, TLTROs, increased HTM limits, on-tap TLTRO, etc. to demonstrate its commitment towards reviving growth. RBI also noted that signs of recovery are far from being broad-based and are dependent on sustained policy support. Further, range-bound oil prices, positive outlook on balance of payment, lower global rates, and easy liquidity by major central banks bode well for yields in India. However, high near-term inflation remains a key risk to yields, as indicated by sharp upward revision of inflation forecast for the next 1 year by RBI. Further, RBI also recognized the same and mentioned that this constrains monetary policy at the current juncture from using the space available to act in support of growth. Further, large supply from central as well as state governments, sharp reversal in oil prices, etc. can also put upward pressure on yields. In view of the aforesaid, we believe there is limited probability of further policy rate cuts. Further, while there is some room for yields to fall from here on, they are likely to remain range-bound, especially at the longer end of the curve. Considering the aforesaid factors, we continue to recommend investment in short to medium duration debt funds. While the credit environment still warrants caution, measures by RBI have eased the spreads on AAA rated bonds significantly. However, opportunities exist in select pockets of non-AAA rated bonds, as their spreads relative to AAA rated bonds are trading at an attractive level. Hence, allocation to credit-oriented schemes or funds with some non-AAA exposure can be maintained or increased to a certain extent in line with individual risk appetite. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.